diagram 24 deals with the treatment of bad debts. Now, it depends on what the initial treatment of a transaction was for you to determine what the bad debt treatment is. So you can see I've got three columns there. The first one in red says trade debtor from a sale in SA. The blue one says export debtor. And the green one says staff loan. So if you've got a normal sale in South Africa, normally we're going to charge VAT at 15%. So how does this work? It says if you paid output VAT across at 15% when you sold it, when the person doesn't pay you, you can claim input VAT at 15% when the person doesn't pay you. With the export debtor, VAT was zero rated, so you paid no VAT across, therefore you don't get to claim VAT as a bad debt because you didn't pay anything across, therefore you don't get anything as a VAT input when you write off this export debtor. And with the staff loans are financial services. And what happens with financial services is financial services are exempt. So there was no VAT when you charge the interest, therefore when you write off the interest there's going to be no VAT because it is exempt. So those are the three primary ways of looking at it. Bad debt, interest charged on overdue accounts. When you charge interest, guys, interest is an exempt financial service. You're not going to be able to write it off. Same as a staff loan, provision of a loan, exempt financial service, you don't get to write it off. Just a couple of considerations for commercial accommodation. In an earlier diagram, in certain times, VAT is only levied at 60% on commercial accommodation. If you only levied VAT at 60% to the customer, you only get to write the bad debt off at 60% of the VAT amount. So your later treatment is going to mimic what your earlier treatment does. Then there's a little block there with group companies with the maroon writing in it. Let me explain why there's a block there for group companies itself. Earlier on, when we said creditors that are more than 12 months old, we're supposed to reverse out the VAT if you haven't paid it within 12 months. We said there for group companies, we don't need to reverse it out if it's in a group company. Similarly, if the bad debt is to a group company, we cannot claim the bad debt as a VAT input claim. So the person who bought the goods in the group will not have to reverse out the inputs and charge outputs. Similarly, we are not allowed to write off the bad debt and claim an input. Nothing is done with it. Just remember the next column in orange. It says if a bad debt becomes recoverable, the VAT treatment on write-off is reversed. So if I've written off a debt and the guy eventually pays, you need to give the VAT back, depending on whether you claim VAT back when it was written off. And then just for sale of a debtor's book, guys, it depends on what's actually happening here. Okay? If you sell off a debtor's book, one of the requirements to actually just claim bad debts deduction is that it needs to be due to you and it must have been included in your gross income. It depends on whether you sell things without recourse, okay, and whether it's your bad debt or not your bad debt. So I mean, if you sell a debtor's book off, there's no bad debt. But if it's with recourse, they can give it back to you and you get asked to pay them out for it, you will then be able to claim bad debt because it's sold with recourse and it's your bad debt again and you'll be able to write it off. So what I'd like you to do is just pause the video, have a look at this diagram, make sure that you understand all the stuff, and then we'll move on. So let's do a whole lot of examples. It says the trade debtors account needs to be written off as a bad debt. The debt stands at 24,000, of which 23 was for a vatable sale, the remaining 1,000 for interest. So what are you going to do? You're going to say, listen, it's a local debtor, 23,000 of it. So I'm going to claim a bad debt, and the inputs on that bad debt was 23,000 times 15 over 115. And on the interest portion, interest is an exempt financial service, so I can't claim any VAT. So there it is, input VAT of 3,000 on the VATable portion, and then no input VAT on the write-off of the interest. It says a staff loan is made to an employee for 20. Staff member absconded from work and could not be located. Remember, staff loans are exempt financial services. Therefore, when you write off the staff loan, because it was a financial service upon which there was no VAT charge because it was an exempt supply, because it's an exempt supply, no input VAT may be claimed on the supply of an exempt supply. So no VAT input can be claimed. It says goods were exported to an overseas customer. The sale was zero rated. 200,000 was written off as a bad debt. So sell it overseas, zero rated. There's zero VAT charged. So when you write off this bad debt, because there was zero VAT charged, you get your claim back, zero VAT, because you get inputs on whatever the output was that you paid. The output is zero, therefore the input would be zero on this write-off of a bad debt. Next one says goods were exported to an overseas customer. The sale was an indirect export and VAT was charged on the sale. 230 written off. Now yes, this is an export, but we did charge VAT in it because it was an indirect export. So if I charge 230,000 times 15 over 115 as output VAT, I'll get to claim back the 230,000 times 15 over 115 as input VAT when I write it off. So the company makes a provision for bad debts of 100,000. The company had never made a provision for bad debts before. You need an actual transaction before you can actually claim input VAT on a bad debt. This is merely a provision for bad debts. You've not identified who is a bad debt and written them off. You cannot claim any input VAT on provisions. They are not real transactions. Therefore, there will be no VAT effect on a provision for bad debts. Number 6. It says a list of doubtful debts totaling 240 was made. 28.5 of the list is considered to be bad, and a provision expense of 40 was made on the remaining bad debts. After the adjustment was made, the provision for doubtful debts stood at 60,000. So guys, it's only what is bad that can be claimed, which is a 28,500 times 15 over 115. Anything that's not bad cannot be claimed as an input VAT by the seller. Okay. The fact that you think they might not pay you does not make it a bad debt. You can only claim the bad debt and the input VAT on that bad debt when it gets written off. So it's only the 28,500 that can be utilized in this question. It says if A Limited sold B Limited 115,000 rands worth of trading stock, including VAT, and both companies are owned 100% by Z Limited, and 20 months later the 115 is written off, what are the VAT implications? So remember, the seller is not going to be paid within 12 months. Therefore, they should normally write it off. But remember, if it's a group company, we do nothing. Similarly, the bad debt is going to be written off because we haven't got paid for it. But because it's a group company, you can't claim the input. So there's no output when the creditor is not paid. There is no input when the bad debt is written off. You just ignore the two transactions together. So there it is. I'm just going to pause for 10 seconds, give you a chance to read through stuff. It says number 8. It says A Limited sold, B Limited 115 worth of trading stock including VAT. A Limited owns 80% of B Limited. 20 months later, 115 is written off. What are the VAT implications? So guys, as far as this is concerned, okay, what needs to happen is the following. So, can you see it says 100% over there? It has to be 100% between group companies. So, where the difference is in this example is, in the previous example, it's 100% owned company. In this example, it's only 80%. Because it's not 100% owned, what's actually going to happen in it is, we're going to have the normal rules. There'll be VAT of 15 if it is output VAT by A and input claim to 15,000 by B. After 12 months, because it's not a 100% owned company, what are you going to do? You're going to reverse out the VAT on the amount that hasn't been paid. And when the bad debt is written off, you can claim the VAT input on the bad debt. So because it's not a 100% connected person, you do the normal VAT transactions on something like this. Next one. A Limited bought 500,000 rands worth of debts from B Limited on a non-recourse basis. Output VAT was charged on all debtors. 34,200 was written off as non-recoverable during the period. So let me just explain, guys. If it's bought with no recourse, that means it's your debt, which means that if it doesn't get paid, you're responsible for it. Because you charged the VAT when you bought the debtors, you can claim input VAT on the amount that is now written off, because it is bona fide your bad debt, because there's no recourse. You can't give it back to someone else. It's your bad debt. Therefore, we can claim the VAT input on the bad debt itself. The last one, number 10. So C Limited bought 500,000 rands worth of bad debts from D Limited on a recourse basis. Output VAT was charged on all debtors, 34,200 written off as non-recoverable, and given back to D Limited, who refunded 34,200 to C Limited. So what's basically going to happen with this, guys, is it's not your bad debt. Because it's not your bad debt, you do not get to claim any input VAT. The original debtor has bought it back from you, and they've refunded the money back through to you. A couple of examples of bad debts recovered now. It says a trade debtor of 7980 for sale of goods is written off in June. In October, the 7980 is now collected. So I claim bad debts when I wrote it off, and I need to reverse it out, and there'll be a VAT output for 7980 times 15 over 115 that gets put into our VAT return. Next one, 2. A trade debtor for 7980 is written off in June. In October, 5750 is paid to the debtor in full and final settlement. You've only received 5750. Therefore, you only need to account for output VAT on the 5750 times 15 over 115, and that was what will be recorded in the October VAT return. When you wrote it off, obviously you'll get a bad debt on the full 7980. But they've only paid you 5750, so you only need to account for the amount that you've collected. It says a staff loan of 10,000 is recovered in November after being written off in May. Guys, staff loan, exempt financial service, no VAT on writing off the bad debt. There's also no VAT on when it gets paid, because it's an exempt supply. It says the debtor was written off for 48,000 18 months ago, which had 45,600 owed from the sale, and 3,300 interest added on for non-payment within payment credit terms. A bad debt, bad input adjustment of 5.6 was made on the bad debt. 20,000 is collected as a bad debt, recovered. So guys, what's basically happened here is as follows, okay? We are claiming we claimed a bad input, but the original one, guys, what happened here is there's sale and interest here. So the way that we do the output VAT is if we cannot allocate it between sales and interest, you do it on a pro rata basis. So if you have a look here, it says 5.6 times 20 over 48,900, 2290 will be recorded as a bad debt, recovered. So you need to apportion it based on what is actually being claimed. So the 5,600 was written off on 48.9. You now need to apportion whatever you get back. Last one. Just illustrative example of 100% group shareholdings. So have a look here. A Limited owns 100% of B and 100% of C. All are registered as monthly VAT vendors. A Limited sold the following on 7 Jan. 115 to B and 172,500 to C Limited. Okay. So what will happen now? So, because this vendor selling to these two guys, input VAT can be claimed on both transactions. Now, what is going to happen? It says there are no payments for 12 months. So, what's going to happen? They're both 100% owned group companies. And what's going to happen with 100% owned group companies is you don't need to account for the creditor not paid within 12 months. You don't need to account for bad debts. Let's see what happens afterwards. In April 20x23, it says 5% of B Limited was sold to a third party. Now let me just explain. It's no longer 100% owned because it is no longer 100% owned and it owes you 115,000 Rand. That is more than 12 months behind to a group company. We now need to account for the VAT. So not on C Limited, because we haven't sold C Limited. We sold 5% of B Limited, 115 was owned. So 115,000 times 15 over 115, 15,000 Rand needs to be reversed out. Okay, so 15,000 Rand needs to be reversed out by B Limited because they haven't paid for the goods within 12 months. And what can happen when the group writes both amounts off? Because the 15,000 Rand was reversed out, you can now claim it as a bad debt. But for the other company, for C Limited, because it was never reversed out after 12 months because it was 100% owned, when you write off the bad debt, you're not allowed to claim the bad debt as a VAT input amount, because the rule is you can only claim it as a bad debt amount if you have reversed out the original VAT in the other 100% held group company or the other group company at an earlier date.